Hello everyone, welcome to Optiongig. This is your host Vivek Somani. I am an option trader by passion and a full-time software executive by profession. If you want to learn how to generate consistent monthly income trading options while working full-time in your day job, then join me in this journey. Today on our menu is checklist for opening option trade. This session is important and will be useful for those traders who have just moving from stock to options, have done some study, understand what the basic option contract is, what are the basic types of option contracts, and are now ready to go ahead and put an option trade. But then they get stuck thinking, how should I pick up a sticker? How should I go about it? So in this session, we will cover what are the various factors that should help you and govern the decision making process for opening an option trade. Alright, so on the list today is for opening up an option trade, we will look at what are the factors that should govern our ticker selection, either the stock or the ETF. There are thousands of stocks and the ETFs on which options are available. Now, which one to pick up is like finding a needle in a haystack, but we will cover through various factors which will allow you to filter down the list and arrive at a few stocks or tickers that you should use for option trading. Next, we will look at the direction consideration. When I talk of direction, it's not north, south, east or west, but is it a bullish, is it a bearish, or is it neutral? Third, we will look at the strategy. If we know the direction, then what are the different strategies available to make a trade with respect to that direction? And lastly, we also need to look at what should be option expiration period. Remember, the options have a finite lifetime. It could be as less as weekly options all the way up to 18, 24 months out options. So what should be our option lifetime is again an important factor we should consider before we place an option trade. Alright, there are a lot of things to cover and hopefully I'll be able to explain it well so that you are comfortable when you start to do your first option trade. Alright, first, ticker selection. We will look at various factors that impact the selection of a particular ticker. The most important factor is liquidity. When you're looking at various tickers for doing an option trade, look at the tickers which have high trading volume. I'm taking a ballpark of 500,000 average stock volume over past 10 days. Why we want to do this? This is because if there is enough volume on a particular stock, means there are many parties who are interested in trading that stock. So such stocks are difficult to manipulate. Hence, there is a less chance that the stock will make unpredictable movements because it cannot be manipulated. Now, once you're trying to do an options, you should also look at that there is good enough option volume on this particular ticker. My benchmark is that at the money option contract should have an open interest of maybe around 100 contract, and we have to take this into consideration so that it is easier for us to get into an option and get out of an option contract as and when we desire. If the volume is low, if the interest is very low, then there is not enough participants for you to sell and to buy back the option contract, so you might get stuck with your option contract if there is not enough interest. So always look at the strike prices where the option open interest is, maybe around 100 contracts. Alright, next one is selection of a ticker based on implied volatility. I think this is very important because as an option seller, our edge lies in contraction in the implied volatility. Means we need to look at the tickers which have high implied volatility, or better, they should rather have a high implied volatility rank. If you want to understand the difference between IV and IV rank, go back and look at the video on volatility and its variants, where I've explained in detail what are the different variants of volatility and how IV and IV rank are different and how IV rank is better than IV. So anyway, for purpose of this particular session, we should look at those tickers which have currently high IV rank, because when we sell options, we get lot more money when the IV rank is higher because the option premiums are higher. So we get more premium and our edge lies in the contraction of volatility. So when the volatility falls down, we buy back the option contract, and hence the difference is the profit. So select the tickers where the implied volatility rank or IV rank is higher. The next, our ticker selection should be also based on the position sizing. This is very, very, very important. You can go wrong in many other things, but never go wrong on position sizing. Let's say you already found a ticker which has got a high liquidity. Everyone would like to trade that. Currently its IV rank is also higher. But what if you already have 4 or 5 trades on it? So you should look at, before you put a new trade, do you already have enough option trades on this particular ticker? How big is the overall exposure? My guideline is I do not want any one ticker to have more exposure than 5% of my total net liquidity. Does not matter how liquid the underlying is, how high the IV rank may be, but if it is already too big a position in my portfolio, sometimes the best trade is to not do a trade on it. So very important, look at your position size, look at the how much exposure you already have on this ticker before you go ahead and put a new trade on the ticker. Do not let any one ticker to be more than a set percentage of your net liquidity. My guideline 5%, you could be choose 2%, 3%, whatever is comfortable based on your risk profile. Next one is diversification. Let's say found a great liquid stock with a high IV rank and I do not currently have any trades on this particular ticker, but I may have a lot of trades on another ticker which is in the same sector. For example, if I found that oil and energy ETF XOP is very liquid, high IV rank, I have no trades on XOP, but then I might have a lot of trades on USO, which is again an oil ETF. I don't want to overexpose myself on a particular industry. So look at the industry diversification. Do you already have positions in this sector? If yes, then ignore it. Try to find a ticker in another industry in which you do not have an exposure yet. This is important from an overall diversification of your portfolio. Lastly, I also want to look at the price of the ticker selection. Though this is not the most important criteria, but it also helps in making sure that the time that I spend on making an option trade is really worth it. If the stock is a lower price stock, then the amount of a premium that you get on that stock is also lower. But remember, you're gonna spend the same amount of time in scanning for the stock, in putting a trade, in clicking the button, and then of course managing the trade. So might as well select the stocks where you get little more bang for your time. Generally, I scan for the tickers which are greater than $20. That does not mean that I have not placed trades on stocks which are less than $20, but just that I would want to keep those stocks at minimum so that I can get maximum bang for the time that I spent in making trades and in managing trades. Next factor that should impact in terms of which ticker to select is look for, are there any corporate events occurring or between the expiration of your option contract? Some of the corporate events are, is there any dividend coming up? Is there an earnings announcement coming up, which comes up after every quarter? Or if it is a biotech, are there any clinical trial results that are happening? Are there any FDA decisions that are coming up? Why these are important? Because these are one-time events which cause a huge movement in the stock prices, and some of these events create uncertainty in the market. For example, earnings, it creates uncertainty in the trader's mind because you never know whether the earnings is going to be good or bad. So this uncertainty increases the volatility in the market. So if you have sold an option and let's say 2 weeks later you have a earnings coming up, the volatility will increase, which goes against an option seller. We want volatility to decrease and not increase. So look for the tickers which do not have earnings coming up in the middle of your expiration period. Similarly, FDA approvals or clinical trial results can impact the stock, especially the biotech stocks, in a major way. The stocks will go high or down based on the FDA approvals. As an option seller, our assumption is that the stocks stay range bound within the one standard deviation. So we do not want to deal with the situations where the stock could move way beyond that. So look for these corporate events and try to avoid them. You may or may not be always able to avoid it, but try to avoid as much as possible when you are picking up a particular ticker. Alright, so that was all around ticker selection. Now we will talk about, once you have identified which ticker you want to put a trade on, now you look at what direction you may want to select. Many newbie traders just look at the ticker direction based on the analysis that they have done only on that particular stock. Let's say you found a stock which has passed through all the criteria that we talked about, the ticker selection criteria, and you are bullish on that particular stock. Should you now go ahead and put a bullish trade? Take a step back and think, what's your current portfolio direction? What's your current portfolio balance? Check your portfolio beta weighted delta to identify the direction tilt of your portfolio. If your portfolio is already too bullish, you really do not need another bullish trade. Even though the stock or the ticker in isolation looks like a great trade, but is not a good trade for your overall portfolio. So before you put a trade on an individual stock, take a step back and look at your overall portfolio. If your portfolio is already very bullish, do not look for a tickers where you have a bullish sentiment. Maybe look for a tickers where you have a bearish sentiment. Try not to go overboard in any one direction. Try to keep a neutral balance on your portfolio, because really we may think where the stock will go, but the reality is we do not know. Stock doesn't move based on our thinking or our whims and fancies. It is unpredictable where the stock will go. So make sure you are ready to play on both sides of market. Try to keep your stance as neutral as possible. So it is important on which ticker you should pick up and or what direction you should pick up. Look at your overall portfolio balance before you pick up that direction. Once you have the ticker, once you know the direction, now let's find out what are the option trades available to express that directional assumption. If your directional assumption is neutral, you could do a strangle, you could do an iron condor, you could do a straddle, or you can do an iron butterfly. Plus there are few more trades, but these are the four generally very common trades used by option trader. If you are a bullish and you want to put a bullish trade, then you could do a credit put spread, or you could do a naked put. Remember, all the strategies I'm talking about is from the perspective of option seller. If you are a bearish and want to put a bearish trade because you want to get a bearish exposure for your portfolio, you could do credit call spread, or you could do a naked call as well. Remember, find your ticker, pick up which direction you want to go, and then you select your strategy. And lastly, once you know your strategy, next thing is, which option expiration period should I select? Should I pick up weekly option? Should I pick up next monthly options? Should I pick up an options which is 90 days far away, or maybe 12 months far away? Generally, to sell options, I look at the option contracts which are expiring within 40 to 50 days. Sweet spot is 45 days to expiration. Why? Because remember, the theta decay or the decay of the time premium in an option contract is not constant. Numerous studies have shown that around 45 days to expiration, the rate of theta decay starts to accelerate. So that means the 45 days to expiration is a sweet spot which provides us the quickest returns for the amount of risk that we are taking. I'll try to explain it a little more in detail. The amount of the time period for which the option trade is still active also exposes us to the amount of risk. If an option trade lifetime is 1 week, so I have a risk worth of 1 week, because whatever stock could do in that 1 week, that's the only risk that I have an option trade. If expiration is for 12 months, I have the risk of the stock to make wild ups or down swings for the next 12 months. So there's a huge amount of risk that I'm taking. The premium will definitely be higher on a 12-month option expiration period, but not as high as the amount of risk that you are taking. The sweet spot is 45 days to expiration, because that provides the maximum amount of theta decay per amount of risk taken. These are some of those things that you should keep in mind before you put in trade. This is the checklist that you should have ready and handy, and maybe make it your muscle memory before you put an option trade. Anyway, thank you for your time. If you have any questions, please write it in comments or email it to optiongig@gmail.com. If you liked what you learned, help us spread the word so others can also benefit from it. Thank you.